Hello children, I am Saly Thomas and welcome to my economics class. In today's session, we will be revising the third chapter of class 10 economics, money and credit. This chapter is very important for your life as well as for the board exam. It is important for your life because this will improve your financial literacy. It is also important for the board exam point of view. So in today's session, we will be discussing all the important questions from the chapter Money and Credit. So what is money? Is it just the paper currency and coins that we are using today? No, money can be defined as any item of value which can be used as payment for goods and services and also for repayment of debts. So money need not be currency alone. Next, what are the functions of money? The most important functions of money are: money is a medium of exchange. This is the most important function of money. It is a medium of exchange. Means, in any kind of transaction or exchange, money can be used. The use of money will make exchanges and transactions easy. Second, it is a unit or measure of value. What does that mean? All goods and services can be priced or valued in terms of money. That is why it is a unit or measure of value. And the third important function of money is it is a store of value. Money can be stored or stocked for future payment. It can also be accumulated to increase our riches or wealth. So these are the three important functions of money, and money as a medium of exchange is coming again later, so we will deal with it in little more detail later. Did money exist all the time? Or was there a time when human beings did not know the use of money? Yes, there was a time before man invented money, and that system is known as barter system. Your next question is, what is barter system? How do you define barter system? Barter system refers to an economy in which goods were exchanged for goods without the use of money. So that is barter system. Without using money, people exchanged goods for goods. Now this system had a major drawback. And that drawback is called double coincidence of wants. So barter system could work only in the presence of double coincidence of wants. Now what is meant by double coincidence of wants? It means that what a person desires to buy is exactly what the other person wishes to sell. Or in other words, two people should meet who are ready to sell or buy each other's goods. Only in this condition, barter system can function. So it is an essential feature of barter system, the double coincidence of wants. And it is also a drawback of barter system. So what is the use of money? Or why is money called as medium of exchange? And how does it solve the problem of double coincidence of wants? That is your next question. Why is money called medium of exchange? Because all transactions or exchanges or buying and selling are made in money, because a person having money can exchange it for any other commodity that he wants. And money provides the intermediate step in the exchange process. Money acts as an intermediate step in the exchange process, and thus it eliminates the need for double coincidence of wants. People can directly exchange money for any goods or services, and therefore it can be used for anything. He can sell the product for money and use that money to buy any commodity of his choice. So that is how it eliminates the need for double coincidence of wants. For example, a person wanting to sell bags and buy books. He can sell his bags, get money, and that money can be used for buying books. Since money acts as an intermediate step in the exchange process, it is called medium of exchange. Now, when money was invented by human beings, was it like the paper currency that we are using now? Or was it different? Yes, we are going to look at the evolution of money. What were the old forms of money and what are the new forms of money? In the old forms of money or traditional money, we had two types or two phases, we can say. The first is commodity money. That means human beings used many commodities as money. And in India also, many objects like grains, cattle and salt were used as money. And this commodity money had many disadvantages. Like for example, there is no uniformity in value. It cannot be stored for long. Most of them are perishable objects and therefore it cannot be stored or enhance wealth. It was difficult to transport these items over long distances and the problem of divisibility. So these were the disadvantages of commodity money. So human beings innovated and he comes to the next phase of money, and that is metallic money. So human beings used many different types of metals, from pieces of iron and copper to precious metals like gold and silver as money. Now this metallic money had an advantage over commodity money. It solved many problems of commodity money. Like for example, they are durable and hence storing is possible. It is much easier to transport them than commodity money. They were divisible. So many of the problems of commodity money were solved by metallic money. But the metallic money also had some disadvantages, like again there is no uniformity in value. The purity of the metal can differ. There will be difference in the weight and shape, etc. Again, when there is a problem, there is a solution. So human beings innovated again and they started giving specific shapes and sizes and weight for metallic money. You must have heard about the gold moher used during the Mughal era. So they had gold coins with the image of the king or the queen on it. The time of printing of issue of that coin was depicted on the coin. So they innovated and it was made more uniform. So these are the two types of old forms of money, that is commodity money and metallic money. Now what are the modern forms of money? Human beings innovated again and he invented the modern currency. Now what is currency? Currency means paper notes and coins that we use today. Currency is the paper notes and coins that we use today. Now, what is the difference between, how do you differentiate between old forms of money and modern money? Modern currency is not made of precious metals like gold or silver, nor are they goods of everyday use like cattle or grains. Commodity money and precious metals had intrinsic value, whereas modern currency has no intrinsic value, they only have extrinsic or face value. What does that mean? The old forms of money, that is commodity money and metallic money, were valuable in themselves. They were useful and valuable in themselves, whereas the modern paper currency and coins have no value in themselves. The paper notes, currency notes that we are using is made of paper. It has no value, right? So, it only has a face value or extrinsic value, a value which is given to it. On a paper note, if it is written 2000, that piece of paper has no 2000 rupee value. It has a value because the 2000 is printed on it by the government. It is only a face value. So, modern currency is without any use of its own. So, if modern currency has no value of its own, then why is it accepted as medium of exchange? That is your next question. Why is modern money accepted as medium of exchange if it has no value of its own? It is accepted as medium of exchange because it is authorized by the government of the country. Because it is authorized by the government of the country. Now, in India, your next question can be, in India, rupee is accepted as medium of exchange. Why? In India, rupee is the accepted currency. Rupee is authorized by the government of the country, and the government authorizes the Reserve Bank of India to print the currency notes. No other individual or organization is allowed to issue currency. So, if any individual or organization issues currency, it is counterfeit money, it is fake currency. It is illegal to issue currency. Only RBI, Reserve Bank of India, has the authority to issue currency. And Indian law legalizes the use of rupee as a medium of exchange, and no individual in India can legally refuse to accept a payment made in rupees. It is the legal tender currency of India, and that is why rupee is accepted as the medium of exchange in India. So, we are finished with the first form of modern money, that is currency. The second form of modern money is deposits with banks. Now, how can deposits with banks become money? So, for that we have to understand how the banking system functions. So, people who have surplus cash with them, extra cash with them, they deposit that extra cash with the bank. Now, why do people deposit their extra cash with the bank? There are three reasons. Firstly, the money is safe with the bank. It is not safe for us to keep large amounts of money at home. There is the risk of thefts, robbery. So, we deposit our extra cash with the bank. It is safe. Secondly, it earns an interest. The bank pays an interest for our deposit, and therefore our money grows in the bank. And third, it can be withdrawn anytime we want. The deposit with the bank, the money that we deposit in the bank can be withdrawn at any time, and hence they are called demand deposits. So, that is why people deposit their extra cash with the bank. And this deposit with bank can be used as money also. The third form of modern money is plastic money or card money. We are all familiar with debit cards and credit cards, smart cards, etc. Right? So, these are also used as modern money. And the fourth form of modern money is digital money, that is net banking and mobile banking. So, these two, plastic money and digital money, can be called as ultra modern forms of money. Now, I said that demand deposits with banks can also be accepted as money. They can act as money. Why? That is your next question. Why are demand deposits accepted as medium of exchange? First point, demand deposits offer an interesting facility, and that facility lends it the essential characteristic features of money. And that interesting facility is the check facility. Meaning, payments can be made by checks instead of cash. Payments can be made by checks instead of cash. Now, what are checks? How do we define checks? A check is a paper instructing the bank to pay a specific amount from a person's account to the person in whose name the check has been issued. So, that is the definition for check. Remember, when you are writing definitions, try and use the words and the terms which are used in the textbook. Now, the facility of checks against demand deposits makes it possible to settle payments without cash, and therefore they are also form of money in the modern times. So, the facility of checks against demand deposits makes it possible to settle payments or transactions, exchanges, business deals without the use of cash, and hence they are also modern forms of money. Now, can we deposit our cash in any bank? No. First, we have to open an account with the bank, and with that bank we can have dealings. We can deposit our extra cash in that bank and can withdraw the amount whenever we want. The next topic and your question is, explain the loan activities of banks. So, when we are learning about banking, we have to know its functions, right? So, we finished one function of bank, that is, banks accept deposits from people. Other than that, what do? Banks accept deposits from people. And what do they do with it? They keep 15% of the total deposits as cash with the bank. And this 15% cash deposit is called minimum cash balance. And why do they keep this minimum cash balance? To pay the depositors who might come to withdraw money on any particular day. We have deposited our money in the bank, and when we need it, we should get it back, right? So, that is why the banks are supposed to keep minimum cash balance to pay off the depositors when they come to withdraw the amount. Why only 15%? And that is because only few people may come to withdraw their cash on any particular day. Not all of them will come to withdraw all the amount. That is why 15% will be sufficient. Now, what does the bank do with the remaining 85%? A major portion of the remaining 85% deposits are used by the bank to extend loans. Loans, what is that? People need cash for various activities, right? People take loans for various kinds of economic activities like business, farming, education, house construction, etc., etc. So, they need cash. There are many people who need cash. So, they go to the bank and take loans from the bank to carry out various economic activities. Now, in this process, what is the bank doing? The bank is mediating between people who have surplus funds and people who need funds. People who have surplus funds are the depositors and people who need funds are the borrowers. So, the banks are mediating between borrowers and depositors. Now, what is the interest of the banks in this? Why are the banks doing it? Banks charge a higher interest on loans than they offer on the deposits. So, when you are taking a loan, we are paying to the bank a higher rate of interest. When we are depositing our cash in the banks are paying us a lower interest. And the difference between these two rates of interest is the main source of income or profit for the banks. The difference between the rate of interest charged on the loan and the rate of interest paid to the depositors. The difference between these two is the main income or profit of the bank. The next topic is credit or loan. And what is the role of credit on people's lives and for the development of the country? So, first we have to learn what is credit or loan and how it is playing a positive role or a negative role in people's lives. First, the definition. Credit refers to an agreement in which the lender supplies the borrower with money, goods or services in return for the promise of future payment. So, that is how we define credit. It is an agreement between who? It is an agreement between lenders and borrowers in which the lender supplies the borrower not with just money, with money, goods or services in return for the promise of future payment. Now, in today's lives, we can see that most of the people are taking loans. Many of our transactions are involving credit. If you ask around your parents and relatives, they will tell you that at least one time or the other they would have taken loans. So, a large number of transactions in our daily activities involve credit. And will credit be playing always a positive role? No. It can play a positive role or a negative role. So, when can we say that the credit is playing a positive role? If the credit helps a person to increase his earnings, his profit, and hence he is able to pay back the loan, and that person becomes better off than before, then we can say that the credit has played a positive role in his life. If the credit helps the person to increase his earnings, repay the loan, and they become financially better off than before, then the credit plays a positive role, or else it will be playing a negative role. If it is not helping to increase the earnings, the person is unable to repay the amount and financially he becomes worse off than before, then the credit has played a negative role in his life. Now, how do we know that credit is useful or not? Let us see the points. Credit will play a positive role in a person's life when he is able to repay it on time. Now, repayment of the loan is dependent on certain factors. Firstly, income from the activity. Secondly, how risky his activity is and whether there is some support in case of loss. So that is how we find out if the person is able to repay the amount. The payment of the loan is dependent on the income from the activity. For what activity, for business or cultivation, for what activity he has taken loan, how much income he is getting from that activity, and therefore risk in the activity, whether that business activity was risky or not, having the risk of failure or not, and whether there is some support in case of loss. Meaning, if that person has some other form of asset like a building or a property or a piece of land or some deposits with bank, in case if there is a loss in his activity, whether there will be a support so that he can repay the amount. Now, many a time we can see that crop loans or agricultural loans by small farmers end up in debt traps and pushes the borrower into a situation from which recovery is very painful. There are two examples given in your textbook. One is of Salim and the other of Swapna. Salim, the shoe manufacturer, took loan and he carried out his business activity. He could produce and deliver so many pairs of shoes on time, and he made a profit in this activity. He could repay the loan and he became better off than before. In Salim's case, credit played a positive role. But what about Swapna's case? Swapna, who was a small farmer with 2 or 3 acres of land, took an agricultural loan from the money lenders at high rate of interest, and unfortunately the crop failed. She could not repay the loan and finally she had to sell a piece of her land to pay off the debt. She became worse off than before. Credit has played a negative role in Swapna's life. When does credit play a negative role? Your next question. When does credit play negative role? Firstly, if the loan is taken at very high rate of interest. If borrowed money is used for unproductive purposes like celebrating festivals or marriages, unproductive. Unproductive means there is no income coming from that activity. So, if borrowed money is used for unproductive purposes, also credit can play a negative role. If invested in activities or business with high risk of failure, then also credit can be negative. If there is delay in repayment. So, what happens if the repayment is delayed? When we take a loan, we have to repay the amount with interest, and this interest will multiply. The cumulative interest will make the amount bigger and bigger over time, and the person won't be able to repay. It will be beyond his capacity. Next, taking fresh loans to repay the previous loan. Many people engage in such foolish activities. They take a second loan to pay off the first loan, and he is unable to repay both. He takes a third loan to repay the second. He gets caught in a trap. from which he is unable to recover. So taking fresh loans to repay the previous loan is not to be done. And the last, failure to repay can lead to the loss of the assets kept as collateral or security. We learn what is collateral little later. Right now, you just understand collateral is a guarantee for repayment of the loan. Many a times when you take loan, you must have seen that they take the papers of your house or property as a guarantee for the repayment. That is called collateral. So these are the various occasions where credit can play a negative role. Next topic is terms of credit. What are terms of credit and how do we define terms of credit? The terms and conditions agreed upon by the lender and the borrower during a credit arrangement can be called as terms of credit. So the terms and conditions agreed upon by the lender and the borrower during a credit arrangement is called terms of credit. And the examples of terms of credit are rate of interest, collateral, mode of repayment and documentation requirement. These four are the four terms of credit. You have to know each of these. At least one sentence you should be able to write about each of these four terms of credit. Firstly, what is rate of interest? The extra amount paid to the lender over the principal amount borrowed is known as rate of interest. When we are repaying a loan, we are repaying the principal amount along with the rate of interest. That extra amount is called rate of interest. The second terms of credit is collateral. What is the collateral? It is a security against the loan. It is a security against the loan and it can be an asset owned by the borrower like land, building, vehicle, cattle, etc. And if the borrower fails to repay, the lender has the right to sell the collateral and obtain payment. That is why the lenders insist on collateral. If the borrower fails to repay the amount on time, he has all the right, the lender has all the right to sell that collateral and obtain repayment. The third term of credit is mode of repayment. The manner in which the loan is repaid, that is mode of repayment. Like for example, the loan can be repaid in a lump sum amount as cash. It can be repaid in the form of a post-dated check or it can be repaid as EMIs. What is an EMI? Equated monthly installment. The principal amount plus the rate of interest will be divided into smaller amounts and will be paid every month. That is EMI or equated monthly installments. And EMI is the common form of repayment, especially when you are taking loans from banks. The last term of credit is documentation requirement. Now when we take loans, especially from banks, etc., they ask for various documents like our identity card, PAN card, address proof, employment and salary records, etc. All these have to be presented to the bank to get a bank loan. Such documents are called documentation requirement of loans. So now that we know about credit, we should know the sources of credit also. Where do people take loans from? Some people go to the bank and take loans. whereas other people may take loans from money lenders or traders or employers, large farmers, friends, relatives, etc. So, all these sources of credit can be classified into two groups. They can be called as formal sector loans and informal sector loans. First, about formal sector. Your question can be differentiate between formal and informal sector credit. Formal sector credit, what are the characteristics? First point, examples of formal sector credit are banks and cooperatives. Loan taken from banks and cooperatives are called formal sector loans. Formal sector loans are under the control of the Reserve Bank of India. Why are loans taken from banks and cooperatives called formal sector? Because they are under the control of the Reserve Bank of India and they have to follow certain rules and regulations set by the Reserve Bank of India. Formal sector credit charges reasonable and justified rates of interest. Rate of interest cannot be more than a specified rate specified by the Reserve Bank of India. There is more documentations and procedures required. Formal sector credit requires a lot of documentation and procedures. They insist on collateral. We have to show some form of asset as collateral to get loans from banks and cooperatives. Legal proceedings have to be followed to recover the loan amount if the borrower fails to repay the amount. They follow only legal proceedings to recover the loan amount if the borrower fails to repay the amount. And even now in the 21st century also, the formal sector credit covers just around 50% loan requirements of people of India. The rest of the 50% depends on informal sector. We will see what are the demerits of informal sector. Informal sector credit means loan taken from money lenders, traders, employers, friends, relatives, etc. This is called informal sector credit. They are not under the supervision of any organization. There is no organization to control informal sector credit and hence there are no rules and regulations to be followed. Informal sector credit charges high rates of interest. According to their wish, they will fix the rate of interest. There is less documentation requirement. They may not even insist on collateral. Instantly, they will give loans. In case the borrower fails to repay, they will use unfair means to recover the loan amount. They will not follow legal proceedings. They can use any means, harassing, threatening, bashing up, any means to recover the loan amount. And even in the 21st century, it covers almost 50% of the loan requirements of people in India. So, these are the features of informal sector credit. And if that question comes to distinguish between formal sector and informal sector credit, please remember to put them in columns. Next, we learned that formal sector credit is supervised or controlled by Reserve Bank of India. Your next question is, how does the Reserve Bank of India supervise formal sector credit? Firstly, the RBI ensures that all banks keep 15% of their deposits as minimum cash balance. 15% to be kept as minimum cash balance to pay the depositors when they come to withdraw the amount. RBI ensures that banks charge reasonable rates of interest. Third, it sees that banks give loans not just to rich business people and traders, but also to small cultivators and small scale industries, etc. And fourth point, banks have to submit periodic reports to the RBI on how much they are lending, to whom they are lending, and at what rate of interest. So, these are the ways in which Reserve Bank of India supervise formal sector credit. Next important question is, cheap and affordable credit is crucial for the country's development. Why? Or, in other words, it can also be asked as, why is it necessary to expand formal sector credit in India? Both have the same points as answers. Let us see. Cheap and affordable credit means what? Will it be formal sector credit or informal sector credit? Cheap and affordable. Cheap and affordable credit means formal sector credit, credit by banks and cooperatives. Now, why is it important for the country's development? First point. So, here you have to say why is the informal sector bad for development, and secondly you have to say why formal sector credit is good for the development. Why is informal sector credit bad for the development? Informal sector lenders charge extremely high rates of interest, and therefore the cost of borrowing is very high. Higher cost of borrowing means a large part of the income of the borrower is used for repayment of loans. High cost of borrowing means a large part of the income of the borrower is going as repayment of loans. There is nothing left for him for his use. And sometimes the amount to be repaid may be even greater than his total income, and such a situation can lead to debt traps. And that is why we hear about a lot of farmer suicides. They get caught in debt traps. They have no assets to sell and repay the amount, and finally they end up in suicides. Next point, why informal sector credit is bad is because people who wish to start new enterprises by borrowing may not do so. The people, when they realize that they have to take a loan from informal sector credit to start a business, a self-employment or any kind of activity, they will not have the guts to do that, because they know that informal sector credit means high cost of borrowing, high rate of interest. So, they will not be able to start that business, which will be bad for the development of the country. Hence, banks and cooperatives should expand their lending activities, as this would lead to higher incomes for people. And here comes the importance of formal sector credit. Banks and cooperatives should expand their lending activities so that this will lead to increase in people's income. So, many more people would then borrow cheaply from banks and cooperatives for various economic activities like farming or business or small manufacturing, etc. And this will lead to development. So, people who were not contributing towards the GDP, towards the national income of the country, will be able to produce and contribute towards the GDP or the national income of the country, which will lead to development. This will also reduce the dependence of people, especially from rural areas, on informal sector loans. So, if banks and cooperatives expand their lending activities, this will reduce the dependence of people on informal sector credit. And formal sector credit also should ensure that everyone receives loans. Whoever wants loans should get loan from the formal sector, from banks and cooperatives. But at present, what is happening? At present, almost 90% of the rich households are receiving formal sector loans at low rate of interest, while 85% of the poor households still depend on informal sector credit. Next topic and your question, why do poor households depend on informal sector credit? We saw in the last point that 90% of the people, almost 85 to 90% of the people, poor people are still depending on informal sector. Why are they not going to the banks? Let us analyze. Firstly, many of the rural areas have no banks. No accessibility to banks in the rural areas. Secondly, need for documentation. The poor people, the poor households have no documents to be presented to the bank. Long procedures involved. Many a time these poor people want the loan immediately. They can't wait, and the banks may take a little long period, sometimes 2 months, 3 months to process the loan. They can't wait. Next point is absence of collateral to show as a security for repayment. They don't have any assets to show as collateral, which is a major problem for people from the rural areas, people from the poor households to get formal sector credit. Absence of collateral. Lack of awareness regarding the risks of informal sector loans. They are not aware what will happen if they take loans from informal sector. And the last is, loans are easily and immediately available from money lenders who knows the borrowers personally. If they want the loan immediately, amount immediately, they rush to the money lender, and the money lender is ready to give them loans at short notice. So that is why poor people, poor households are still depending on informal sector credit. Our next topic is self-help groups for the poor, their functioning and significance. So we saw that many of the poor people are still depending on informal sector credit. So people have been devising new ways how to make available cheap credit to poor people. So one such initiative which has become successful all over India is self-help groups for the poor. Poor people join together and help themselves. Self-help groups. Functioning. It is a newer way of providing loans, micro loans, small amount loans to the poor by organizing rural women into small self-help groups, SHGs, self-help groups. Now, who are the members of these SHGs? 15 to 20 members of the same neighborhood meet and pool in or collect their savings. 15 to 20 women of the same neighborhood join together and form a self-help group, SHG. And what do? They meet often and collect or pool in their savings. And these savings can be as low as 25 rupees or any amount which they can afford. Now, what is the use of that collected amount? Members can take small loans from the group on a low rate of interest. They can take loans from that collected amount for which they have to pay a very low rate of interest. Now, if the group is regular in savings, that group becomes eligible for bank loans, which is sanctioned in the name of the group. So, if the group is regular in meeting and saving, and when their saved amount becomes a decent large amount, that group becomes eligible to get loans from the bank. And that loan can be used by the members. Loans are meant, what is the objective of the loans given? The loans are meant to create self-employment opportunities or any other productive purpose. So, any self-employment opportunities or small business like tailoring or buying cattle, any kind of productive purpose, they can get loans. All important decisions regarding the loan activities, the amount granted, the purpose of the loan, the rate of interest, repayment, all these are taken by the members themselves. So, you can see that these poor women from rural areas are empowered by self-help groups. They can take their own decisions. Next, repayment of the bank loan is the responsibility of the group, not of the individual. The repayment of the bank loan, once they take a bigger amount loan from the bank, the repayment of that loan is the responsibility of the group, not of the individual. And due to this feature, the banks are willing to lend to these poor women and help them overcome the problem of lack of collateral. Why the poor people are not getting a bank loan is because of absence of collateral. Now, if they are members of a self-help group, the banks are willing to lend to these groups. Why? Because the repayment of the loan is the responsibility of the group, and hence the banks are willing to lend to these self-help groups even in the absence of a collateral. Now, the significance of SHGs. SHGs are the building blocks of organization of the rural poor. They are building blocks of the organization of rural poor. We know that when people are united, when they are organized, they can overcome many problems. And these SHGs makes these poor women financially self-reliant. No, they can get loans and they can carry out many economic activities with the help of the loans taken. So, it makes them financially self-reliant. It also becomes, this group also becomes a platform for discussing various social issues faced by them like health, nutrition, education of their children and domestic violence. It becomes a platform for these people, these poor rural women to meet together and discuss the issues that they face in life. So, that is about the functioning and significance of self-help groups. We move on to the last topic, the last question, Grameen Bank of Bangladesh. What is the importance of Grameen Bank of Bangladesh? This concept of Grameen Bank of Bangladesh was founded by Professor Muhammad Yunus of Bangladesh in the year 1970, and he is the Nobel Peace Prize recipient of 2006. For this initiative by him, he was awarded the Nobel Peace Prize. Now, this Grameen Bank of Bangladesh is one of the biggest success stories of providing micro loans, small amount loans at low rates to the poor. And almost all the borrowers of Grameen Bank of Bangladesh were women from the poorest sections of society. And these poor women proved that they are not only reliable borrowers, but can also start and run a variety of economic activities successfully. So, this is the importance of Grameen Bank of Bangladesh. The lesson that we learn from this initiative is that a major way to improve the rural areas, that help in the development of rural areas, is by providing micro loans or small amount loans to the poor people. So now we know the importance of credit, how credit plays a major role in the development of the country. So these are the different questions that can come from the chapter Money and Credit. Thank you for watching.